Would you drive a car at 200 km per hour on a crowded street? Of course not. You would slow down, wear a seatbelt, and stay alert. Leverage in trading is like speed. It feels exciting. It promises faster results. But one small bump can cause a crash. Without leverage, a 2% market fall is a small dent. With high leverage, the same fall can break the car. In trading terms, it can break your account. Traders love leverage. They see it as free profit booster. Brokers advertise, trade 10 times your money. It sounds tempting. But most traders ignore the hidden side.
Over 93% of traders lose money in the markets. Not because of the market, but because of their mindset. Hi, I'm GC Sharma, founder of Ghar Investor, former head of financial education at the National Stock Exchange. After 3 decades in the markets, I'm here to help you trade with discipline, not emotion. Welcome to Bounce Back Trader, India's free YouTube learning series for traders who want to bounce back with clarity and confidence.
Leverage multiplies both profits and losses. The knife is sharp on both edges. Example, you buy Reliance with 100,000 rupees. No leverage, stock rises 2%, right pointing arrow gain 2,000 rupees. With 5x leverage, exposure 500,000 rupees. Same 2% rise, right pointing arrow gain 10,000 rupees. Feels great. But what if price falls 2%? Without leverage, 2,000 rupees loss. With 5x leverage, 10,000 rupees loss. One small move erases 10% of capital. 2 formulas make it clear. Formula 1, leverage ratio equals exposure divided by equity. If you have 100,000 rupees and take exposure of 500,000 rupees, leverage equals 5x. Formula 2, percent PL on equity approximately equals price move percent times leverage. A 1% move with 5x leverage approximately equals 5% change on equity. A 3% move with 5x leverage approximately equals 15% change on equity. This is why leverage accounts swing wildly. Nifty 50 moves 0.5% to 1% on many days. Bank Nifty often moves 1% to 2% in a session. With 10x leverage, a 2% move becomes 20% swing on equity. One bad day can damage months of progress. Worked example, Nifty 50 ETF capital, 100,000 rupees. No leverage, buy ETF worth 100,000 rupees. If Nifty rises 1%, right pointing arrow profit 1,000 rupees. With 5x leverage, exposure 500,000 rupees. If Nifty rises 1%, right pointing arrow profit 5,000 rupees, 5% on equity. If Nifty falls 1%, right pointing arrow loss 5,000 rupees, 5% on equity. 2 such losses and your mind panics. Panic creates more mistakes. Worked example, Reliance Futures capital, 200,000 rupees. You take exposure approximately equals 1 million rupees, 5x. Reliance falls 1.8% intraday. Equity drops approximately 9% in minutes. If you freeze, the next 1% fall makes it approximately 14%. This is the hidden danger. Why do smart people still misuse leverage? 1. Greed, faster profits sound irresistible. 2. Overconfidence, I can predict, nothing will go wrong. 3. FOMO, social media shows big gains, hides big losses. 4. Misleading focus, ads show profit potential, not risk. 5. Illusion of control, I will exit before it gets bad. 6. Anchoring, stuck on entry price, you hold losses too long. 7. Revenge trading, after a loss, you increase leverage to recover fast. 8. Underestimating gaps, overnight gap downs ignore your intraday stop loss. The market moves faster than human reactions. A gap in Reliance, HDFC Bank, or Infosys can jump right over your stop. Higher leverage means larger damage when that happens. Ravi and Reliance. Ravi used 10x leverage on Reliance intraday. Price fell only 1.5%. His equity fell approximately 15%. He froze, did not exit, and the slide continued. By the close, he was down approximately 22%. He stopped trading for weeks. Meera and HDFC Bank. Meera used only 2x leverage. She set a small stop loss and respected it. Stock moved against her by 2%. Her loss was approximately 4% on equity. Painful, but manageable. She traded calmly the next day. Arjun and Bank Nifty. Arjun traded Bank Nifty futures with 6x leverage. A volatile day moved 3% intraday. His equity fell approximately 18% in hours. He chased the loss with more leverage. By evening, the account was down 30%. He realized leverage without rules is a trap. Kavita and Nifty ETF. Kavita avoided leverage for core positions. A 2% fall hurt only 2% of her capital. She stayed calm and bought again later. She grew steadily because she survived the bad days. Stories show the truth. Leverage is not evil, but misuse of leverage destroys traders. Step 1. Know your true exposure. Write this before every trade. Exposure equals quantity times price, or futures value. Leverage equals exposure divided by equity. If leverage is above your rule, reduce size. Step 2. Cap risk per trade. Risk is less than or equal to 1% to 2% of equity per trade. Let the stop loss and leverage fit inside this limit. If stop is wide, reduce leverage and size. Step 3. Respect the stop with leverage. Stop loss is non-negotiable. Place it with the order. Do not widen it. Never average losses in a leveraged position. Step 4. Use a daily loss limit. Example, if I lose 3% of equity today, I stop trading. Leverage makes emotions spike. Stopping early protects mind and money. Step 5. Separate core and trading buckets. Core holdings, e.g., Nifty ETF, blue chips, right pointing arrow, no leverage or very small. Trading bucket, short term, right pointing arrow, small leverage with strict rules. This keeps your future safe. Step 6. Mind the overnight gap. Leverage plus overnight risk is dangerous. If you carry futures or options, hedge or reduce size, protect with a put, or close before close on volatile days. Step 7. Practice with a leverage journal for each trade. Record, leverage used. Stop loss distance. Percent risk on equity. Emotion level, calm, anxious, greedy. Review weekly. Cut leverage when emotions run hot. Step 8. Start at 1x minus 2x and scale slowly. Trade 1x minus 2x for a month. If you follow rules and journal shows control, consider 3x. If you break rules, drop back to 1x. Skill first, speed later. Step 9. Align leverage with volatility. Bank Nifty is more volatile than Nifty. Infosys may be calmer than small caps. Higher volatility. Right pointing arrow, lower leverage. On event days, RBI policy, budget, results, reduce leverage or hedge. Mini toolkit, quick math, percent P, L on equity approximately equals price move percent times leverage. Pre-trade checklist, leverage, stop, position size, max loss. Post-trade reflection, did I obey my plan with this leverage? Leverage is speed. Speed is thrilling, but speed without control is a crash waiting to happen. Used wisely, leverage can boost returns. Used carelessly, it can wipe accounts. Reflection, write one rule about leverage you will never break. Example, I will not use more than 2x leverage until my journal shows 4 calm, disciplined weeks. Action, for your next trade in Reliance, Infosys, HDFC Bank, or Nifty ETF. Compute leverage first. Write it down. Fit position size so that 1 to 2% risk rule holds. Place the stop. Then trade. Final analogy, a sharp knife cuts vegetables fast. In careless hands, it cuts fingers. Leverage is that knife. Handle it with respect. Protect your capital first. Profit will follow.
You've just completed another lesson of Bounce Back Trader. Remember, trade with discipline, not emotion. Subscribe to the channel, share your thoughts in the comments, and continue your journey in the next video. Let's change that 93% story.